Hello traders, welcome back to the Forex Gig, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the Ross Hook pattern, a technical formation that helps traders identify high probability trade setups across multiple time frames. This pattern was developed by Joe Ross, hasn't proven its reliability in both trending and ranging markets. You will learn how to spot this setup, understand the psychology behind this setup, and most importantly, how to execute trades with precise entries and exit points. Now we start by understanding the Ross Hook pattern. The Ross Hook pattern emerges from a foundational price structure known as the 1, 2, 3 pattern. Now, this formation is the first signal that market trend might be shifting direction. Now, you think of it as a way the market will tell you that it is trying to show signs of exhaustion in the current movement. So, this is the pattern that we are expected to see on the chart. This is the pattern we are meant to see on the chart. In its simplest form, this pattern develops when market shifts three distinct points. For a bullish setup, we will see point 1 forming a bottom. The point 1 would form a bottom, followed by a point 2 creating a peak. The point 2 creates a peak, followed by a point 3 establishing a higher low. Now, the structure tells you that buyers are gaining control in this market. Now, this is the progress of the Ross Hook pattern. Now, the Rock Hooks itself forms after this initial 1, 2, 3 pattern. Once this pattern completes, that's when price breaks above the 2 points, the point 2 area. Once price breaks above this, it creates what we call a violation candlestick. The moment we see price breaks above this point 2 area, it creates what is called the violation candlestick. Now, this breakout is crucial because it confirms the trend direction. This breakout is crucial when it forms the trend direction. However, the magic happens when price pulls back slightly, creating the characteristics called the hook's shape. Now, we expect price to pull back to create the hook shape before going in its intended direction. Now, this is what the pattern is all about. What makes this particular pattern reliable is its proven track record across multiple markets. Oxford University researchers tested it across 42 different assets over 3 decades rather, demonstrating consistent profits. You are not just looking at random market formation, but you are seeing a pattern that withstood the test of time. Remember, the Ross Hooks isn't just a standalone pattern, but this pattern, it's your confirmation that the trend is likely to continue. When you spot this pattern, you are seeing what professional traders see: a high probability setup for a trend continuation. Now, let's look at the basics of this pattern, or let's see how we can apply this to our trading strategy. We have to break down exactly how to trade the Ross Hooks pattern with precision and discipline. Your success with this pattern depends on the following specific rules for entries, exits, and risk management. To validate your Ross Hooks pattern, you need 3 key confirmations. First of all, we ensure that our 1, 2, 3 pattern completes with a clear price point. And as we can see, this is my point 1. This will be my point 2, creating a peak, and this will be my point 3. Remember, we have to wait for price to break structure at the break above the point 2 region. Once we see price break above the point 2 region, this is where the magic happens. We have to wait for price to fall back to the point 2 region. comes back to retest that area. Now let's see what let's see we watch for the violation of the point 2. Once price violates the point 2, we look for the hooks formation with a shallow retracement. There should be a shallow retracement, not retracing back to this full point, but a shallow retracement. Deep pullbacks often indicate pattern failure. Now your entry rule: you enter the trade when price breaks above the hooks in an uptrend or below the hook in a downtrend. For in case of an uptrend, we enter when price breaks above the hook. This patience prevents false breakouts and improves your success rate. So at this area, when it forms the hooks pattern, we will wait for price to break above the hook pattern. We can wait for price to break above this area to confirm your trade. You can decide to enter when price breaks above the original hooks pattern, not the point 2, the hooks pattern. Now when price breaks above it in an uptrend, we have to wait for a candlestick to close beyond the hooks pattern, and as we can see, a bullish candlestick has closed beyond the hooks pattern. This patience prevents false breakouts and improves your success rate. Now we have to know where to put our stop loss. Remember, we have to place our stop loss just below the recent swing low. You can place it just below the recent swing low, and you can place your take profit. Our first target for our take profit should be a previous swing high. We can set it at a previous swing high, or we can target a 1:1 or 1:2 as the case may be. We place our second target as the 1.618 Fibonacci extension in case you want to make use of the Fibonacci extension. Now let's see another example of this setup. As we can see, this is another example of the hooks setup where price breaks below, retraces up to form the point 2 peak, comes down. Let's get this straight again. Price is in a downtrend, making series of lower lows, lower highs, lower lows, and we had a shift in market structure, creating a lower high. Price then created a peak. This is the peak where price created after the lower high. Price created a peak and formed a lower high. It then created the point C. When price created the point point 2. When price creates the point 2, this is the point 2. In some cases, we can mark this area here as the point 2. We can mark, let's re-get this very well. So when price is trending in the downside, creating series of lower lows, lower highs, lower low, price creates the peak, which is the point 1, then retraces and creates the point 2. This is another peak before it clears the point 3. The point 3 signifies the initial higher low before price breaks above the point 2. When price breaks above the point 2, we can confirm that markets have shifted structure. Then we have to wait for markets to retest the point 2 before we would want to consider trading this strategy. Then we wait for price to break the hooks top to enter. It is basically a confirmation of a confirmation. Now this is where we see our initial break of structure, but to further confirm the break of structure is a strong break of structure, we wait for the hooks top. This is the Ross hooks pattern top. We wait for the Ross hooks pattern top to finally break with a close above the breakout zone, a candle close above the breakout zone, to confirm that we are in a continuation of the trend. we are changing, we in the continuation of the reversal of the trend. This is what we are looking at. We need to also know that when we are entering this strategy, we have to keep our risks consistent. We should always trade at least 1% of our trading balance or our trading equity per trade. We need to risk only 1% or at least 1 or 2% of our trading capital per trade. This is what we are allowed to risk in the market to keep us in the game for a longer time. This approach allows you to withstand multiple losses while waiting for the bigger trades to take over. So if I'm to take this trade at this area, I will take the trade when I notice price breaks and closes, the candle closes above the breakup zone. I put my stop loss just below the low. Then I can decide to trail my stop loss to the next level, or I can decide to take profit at the next resistance level, or I target a 1:2 or 1:3 as the case may be. Always remember to adjust your position size based on the market volatility. During a high impact news event, either avoid trading or reduce your position size to half. This pattern works best during trending market condition. So always check the higher time frame for trending market before entering the trade. We have to check when the market is trending before entering the trade. On another area in the market, we can decide to wait for we have to avoid trading this pattern in a ranging market. We avoid trading this pattern in a ranging market. So let's get a bearish example to better understand this pattern. So for a bearish scenario, what we are looking for is for the market to create its peak, break the structure, come back for a shallow retest, then breaks the structure again to confirm the hooks pattern before we see a retest to the area, to the hooks top. This should be the retest to the hooks top before we enter our trade. This is basically what we should look for in a bearish scenario. So what's going to happen from my screen is we notice the market was trending to the upside and decided to form the hooks pattern. And as we can see from the hooks pattern, we see price formed its peak, came down, came to retest, it retraces and forms a higher low. It breaks down, forming a lower low. It retraced again to form the hooks pattern, to retest the area to form the hooks pattern before price broke the high of the low of the hooks pattern. And remember, we are entering once we have confirmed the break of the hooks pattern. So this is where we expect to take our trade from. Once we have confirmed price has switched structure and has broken the structure multiple times from our initial structure, and candle closed with a strong bearish confirmation. Once we notice the candle broke with a strong conviction, we will take our trade in this area. This was the area where price broke and closed below with the candle. We'll take our trade at that area. We'll put our stop loss above the high. Then we aim for our 1:2, 1:3 as the case may be. This is how we capitalize on the rocks hooks pattern. It is a basic principle pattern that we can follow. We also have to confirm from the higher time frame that we are indeed in a downtrend, overall downtrend scenario. Before we would want to capitalize on this pattern, we first of all confirm that we are in a downtrend market. This is to better validate our trade setup. So by following the precise rule, you transform your Rock's pattern into a complete trading strategy. And as you can see from the higher time frame, the market was shifting its structure, further confirming that we are in a bearish scenario. So by following these footsteps, you are transforming your Rock's pattern into a complete trading strategy. By following its rules step by step, you can capitalize on this forex trading pattern. If you do not understand, you can rewatch the video as many times as you want to get a bigger picture of the Rock's pattern. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.